Good afternoon and welcome to day 13 for managerial accounting. This is the fall 2022 semester. First, I need to apologize because I told you last week we talked for a few minutes about 6-week grades, and I told you at the time that they were due yesterday. Yesterday was the end of 6 weeks, but those grades are not due until tomorrow. So if you were looking in Banner today for 6-week grades, you may not have seen them because they're not actually due until tomorrow afternoon. So please, everything I said about yesterday, take to tomorrow. And that means, Thursday or after, you should be going into Banner to check your 6-week grades and thinking about a strategy, how to maintain those grades or how to improve those grades if you're not happy with what you see there. Then today in class, we will be finishing up chapter 20. We'll be starting with exercise 6 in chapter 20 in the See Now exercises. So if you haven't yet, please go ahead and open those now so you're ready to go in just a moment. So the chapter 20 exercises should be submitted by the end of the day today in See Now. And then on Thursday, the chapter 20 problem would be due. We'll be starting chapter 21 on Thursday. So the pre-quiz should also be submitted on Thursday. And as we discussed last class, step 2 of the annual report project, which is just finding your 3 sources. One is going to be the company, and then you need 2 additional external sources. So please make sure you're ready to submit those by Thursday as well. Last class, we started chapter 20. So I want to remind you about the reference materials in Brightspace. The chapter 20 folder has a few, in addition to the video links that are always going to be there, there are a couple extra items here. One of these, we may have looked at all of these last class, but just a reminder that there is that page of useful formulas. We'll be moving on with that second formula right here, how to calculate the number of units. So we'll be using that today in class. You want to make sure you have access to that in your notes or here in the reference materials. I'm pretty sure I also showed you this partial explanation of chapter 20, the page that I couldn't get to insert spaces even though I was trying. So it's a bit condensed, but it's there if you're working on the chapter 20 problem and get stuck. And also, this is a part I'm not sure if we talked about this last class. There is a video here that may be helpful for you on the exam 2 extra credit, which is the reciprocal services method, and then the chapter 20 problem. So there's maybe further assistance there for the chapter 20 problem if you're working on that and get stuck. I would always prefer that you try those things on your own first, and then if you get stuck, go to the reference materials, just because that will be good information for you to know what you can accomplish on your own without that extra boost. And as always, if the reference materials I've provided here are not sufficient and you have additional questions, I'd be happy to help with those. So before we go to our exercises for chapter 20, does anyone have any questions? Anything else you want to talk about? Okay. Okay, so we'll go to our exercises now. And as I said, exercises 1 through 5, we did most or all of that together, and you have the information to be able to finish those up if there's anything that you did not yet finish with us in class. And so we're going to get started with exercise 6 today. We are familiar with the concept of contribution margin. And what that means, it's the revenues minus the variable cost. It's what's left of the selling price to apply toward our fixed costs. And we specifically talked last class in our formulas about contribution margin per unit. So if I were to go over here to these formulas again, to calculate the number of units we take the fixed cost plus the profit and divide by contribution margin per unit. I had mentioned last class that I think the book makes it a bit unnecessarily complicated because they seem to talk about it like there are two separate formulas to find the number of units. There's one for break even, and then there's another one if you want to make money. Well, it's really not the case. It's the same formula, but just we know if you want to if you're looking for the break even point, profit then would be 0. So it is just this one formula, but if you're asked for break even, you're going to plug in 0 for the profit. That's what break even means. You didn't make money, but you also didn't lose money. So let's go to our exercises and recognizing we're going to be using that formula. And get my annotate up here. So in exercise 6, it says, for the current year ended March 31st, Cosgrove expects fixed costs of $27,600,000, a unit variable cost of $805, and a unit selling price of $1,150. We're first asked to calculate the anticipated break-even sales. So I'm just going to type kind of a shorthand of what the calculation is. This is the formula that I just showed you in the reference materials. And so we'll start out with finding the break-even units and our fixed costs. I'm just plugging in what we were given, what we already know from the formula. So from the exercise. So the fixed cost, $27,600,000 plus the profit. Well, this is the break-even point that we're finding here in letter A. And so the profit would just be 0. Divide that by our contribution margin per unit. And knowing what we learned last class, that would be our selling price minus the variable cost, both of those being the per unit costs. And so our contribution margin, after we cover the variable costs, and we know those variable costs are not going to be incurred, because variable costs would be 0 if we weren't making any product. So for every product, every unit of the product we make, we incur $805 in costs that would not be incurred if we weren't making the product. That leaves $345 of the selling price to apply toward our fixed costs and ideally to make a profit in the long run. And so if I punch that into my calculator correctly, the company, Cosgrove Company, would need to sell 80,000 units to break even. That's exactly covering their fixed costs, leaving no extra for profit. Everybody okay with that? Okay. So let's move ahead then to our part B and we hope much more realistic scenario that the company isn't happy just breaking even, but instead they want to know how many units would they need to sell to make a targeted profit. And this exercise asks us, what if they want to make an operating income of $5,175,000? So that's the profit that they're targeting. We already know that the contribution margin per unit is $345. And so I'm not going to retype that whole equation, but we know it's the selling price minus the variable cost. So we know that the first 80,000 units are going to cover those fixed costs. And really what we're calculating here is how many more units would we need to sell in order to earn $5,175,000. So there's really two ways we could have gone about this since we already had the break-even point. We could have simply done the calculation like this: additional units. So we know that the first 80,000 units covers. We know that the first 80,000 units covers the fixed costs. How many more units would we need to sell to earn that profit? Once you cover the fixed cost, the concept of fixed means it's not going to change if we make more units. So once we cover the fixed costs, each additional unit adds $345, the contribution margin, to our bottom line, to our operating income. And so the 80,000 first unit, the first unit we sell, our profit's $345. If we sell 10 units past the 80,000, our profit's $3,450. If we sell 100 units, it's $34,500. Every additional unit past the 80,000 does not change our fixed costs. And so the only costs we would have associated with those units are the variable cost, leaving $345 to go straight to the bottom line. So as we finish up this exercise, my warning is just make sure you read what the question is asking, because it could have been phrased, part B could have said, compute how many additional units you would need to make to realize that operating income. And so the answer would have been just the 15,000 beyond the break-even point. This is asking the total units, but you need to be careful that you recognize what exactly is being asked. Before I clutter up the screen, get my green check marks on here, any questions, anything you want to ask about? Everybody's good? Okay. Then we will keep going. Exercise 7. So I am going to ask you to try this one on your own, but right now during class. So I'm going to pause the recording, ask you to do the calculations on your own, and then once you have your answers, you can use the check my work button and try again if you don't get it the first time. But once you are ready, go ahead and restart. I will briefly explain my answers, which will be on the screen, and then we will move forward. So this is one of the, before I pause, this is one of the reasons that I told you last class. This is probably my favorite chapter because it's so easy, I think, to see how what we're learning in this chapter can be applied by real life managers to improve the way the business is run, to improve our profitability. And certainly this is something that a company would be considering. They calculate their break-even point and they say, maybe that's not good enough. Maybe we can't sell that many. And so they're thinking of changing the selling price. And so this exercise has you do two separate calculations. What would be the break-even point when we sell this at this price? What would happen if we raised our price to 8,000? So you're going to do two separate calculations using that same formula. And when we restart the video, I'll talk about the implications of the results. Okay, so now that you've had a chance to try that on your own, you can see that at the lower selling price, obviously that is a lower contribution margin. It's going to take more units to break even, 7,500 units just to break even. Where if they raise the selling price, they would need to sell only 6,500 units. And I've got the calculations here on the screen for you. So what are the implications of this for business? As a manager in a business, do we get to just raise the selling price to whatever we want it to be? Is our goal to sell the product at the highest price possible? is definitely not. It's not a question of, well, can we sell one unit if we sell it for $1 million? The question, or the purpose, the goal of a business would generally be to make the most profit possible, not to sell the most units, not to sell a single unit at the highest possible price, but to maximize our profitability. And so I'm going to talk just for a second about how this relates to what I know at least a couple of you might be learning in economics this semester, and some of you may be covering in future semesters. So we know from the basic law of demand that all else equal, if we raise the price on the product, that, so in this case from 75.20 to 8,000, we know that fewer customers are going to buy our product. Our customers are going to be less willing and able to buy our product if we're charging a higher price. So the question isn't, should we raise the price and then only have to sell 6,500 units? That doesn't cover the whole thing, because maybe we can sell 7,500 units if we keep the price at 75.20. But if we raise the price to 8,000, we know that our sales are going to drop. Maybe they drop down to only 6,000 units. So there are a couple things in play here. One, just the basic law of demand. Two, something that, again, you'll learn in when you take, if you take microeconomics. Two is this concept of elasticity of demand, which elasticity of demand, price elasticity of demand to be specific, means that it's a measure of how sensitive our customers are to a change in price. And so whether we can raise the price is a combination of a lot of factors, including how sensitive our customers are going to be, which reflects the overall price. How does it fit into their budget? How much, whether that product is a necessity or a luxury item, and what percentage or what proportion of their budget. So we're going to be more sensitive to a change in price if the item is already a high ticket item, where you might not notice a change in price if you're buying something that's cheap, right? Because it's still going to be pretty cheap, even if it goes up 20%. We're also going to be more sensitive to a change in price if it's a luxury item than if it's a necessity. If you need it, and we see that with gasoline, you know, having high prices right now, people are still buying gasoline because they still need to get to work, and they need to get home, they need to get to school. And so customers are maybe making some other budgetary decisions, but not necessarily curtailing their use of gasoline as a necessity. So I know this is accounting class. You're not responsible for knowing how the economics piece fits in, but I do like you to keep those concepts in mind, that there's a lot of content from other classes that you might be required to take for your degree that helps you with understanding how some of what you're learning in this class applies in business. So any questions about this exercise or anything else so far? Okay. So our next exercise, let me clear the screen here. Our next exercise, I want to go to the PowerPoint and talk from here for just a moment. First, and I talked a little bit about this last class, but I wanted to really put it right in front of you, and it's relevant at this point because we're going to start talking about sales mix, which is addressed on this slide. So when we use CVP or cost volume profit analysis, we have to make some assumptions, and the less valid these assumptions are, that is, the more we violate these assumptions, the less useful or reliable our CVP analysis results are going to be. So for class in particular, we make these assumptions that there is a straight line relationship between our total sales and total costs. We talked about that last class a little bit as we talked about using the high-low method, and there has to be a straight line relationship in order for us to use the formulas that we're using. Last class, it was in the context of using the slope intercept form of a line, but it applies just as well to what we are doing here. We assume that we can identify the fixed costs and that the variable costs remain constant per unit. That's what leads to that straight line relationship. We also spent some time talking about relevant operating range. And so we need to know or expect that once we identify that relevant range, that we can accurately predict our costs within that relevant range and that they're not going to go up or go down. A cost that is fixed across that entire range. We also have to be able to separate any mixed costs into their fixed and variable components. And I would go a little bit farther with that third bullet point to say, we also have to know which costs are fixed and which are variable, or be able to determine that. So if we think a cost is fixed and it turns out it's variable, that's going to change our analysis. It's going to make it less reliable, less robust. The fourth bullet is the one that becomes important for us starting in exercise 8, and that is the sales mix is constant. So up to this point, we've been talking about companies that are making only one product in only one size, and they charge every customer the same price. While that really simplifies our calculations, it's not very valid in the real world. We can still use the CVP analysis the formula that we've been using. We can still use that without any changes and apply it just to one product, even within a company that makes 1,000 products or 10,000 products. But we might want to make some more generalized statements about our company that might make more than one product without having to, and be able to talk in general about the company as a whole. And so starting in exercise 8, we are going to be looking at a company that sells multiple products, maybe in multiple sizes. Keep in mind that we are still making the assumption that each unit of the product is sold for the same price. And to bring economics back into it, in economics, we talk about, and this is more macroeconomics, we talk about being able to price discriminate, which means charging different customers different prices based on where they're buying it. So think about, if you go to buy a gallon of milk, if you buy it at Wegmans, it's going to be one price. If you buy it in the local 7-Eleven, it's probably going to be higher priced. They're segmenting the market. They're charging you more for the convenience of being able to get it on the corner rather than having to drive, maybe a few miles to get to Wegmans. So in exercise 8, we're going to start looking at what if they're selling more than one product? How do we use this formula for the company as a whole rather than looking individually at each product and having to be able to identify which fixed costs go with which product and so on. Finally, the assumption an additional assumption we are making is that anything we produce this period, we are also selling this period. And so the reason that's important is if we're producing product and not selling it, keep in mind that those costs for that product, because those are inventoriable costs, are going to go on the balance sheet, and it's going to change what happens on our income statement as we maybe inventory product and absorb some of those fixed costs into our inventory. Skip ahead and start talking about sales mix. But any questions about those assumptions? So if those assumptions are not all true, it doesn't mean we can't use CVP analysis. It just means it's not going to be as robust. We might need to build in a little bit more margin of error or margin of safety. And we'll be talking about that when we get to our last exercise today. So many companies, I would say most, virtually all companies sell more than one product, and they sell each of the products at different prices. Each of those products is going to have its own variable costs and therefore different contribution margins. So we know in that break even, or excuse me, that units calculation, that formula that we used in the last couple exercises, we know that the formula includes contribution margin per unit. So what do we do if there is not one single contribution margin per unit, but we have a different one for each product that we sell? What we are going to do then is take into account the sales mix, and you can see the definition of sales mix on the slide, the relative distribution of sales. So by relative, it means we aren't saying you sell one case, you sell 4 cases, but it means we say you sell 10% of this product and 20% of your sales are from this product and 50% are from this other product. And what we are going to do then is take all the individual contribution margins and weight them based on the sales mix. So you can see here the sales mix when we sell 8,000 of product A and 2,000 of product B, that's a total of 10,000 products. 80% of them are product A and 20% are product B. So we calculate individually the unit contribution margin, but then we apply the weight based on the sales mix. And the sales mix is, just to restate this, the sales mix is based on the number of units that you sell. Number of units that you sell. That's an important distinction. So let's go to our next exercise, which is exercise 8. And we are going to look at a slightly more realistic scenario where this company sells 2 products. If we can do this calculation for 2, we can do it for 22. Dragon Sports Inc. manufactures and sells 2 products, baseball bats and baseball gloves. So I'm going to set up a little table here. I'm going to set it up right along with what they have. That'll fit nicely right in here. Extend that line a little bit. And I'm going to have a calculation for contribution margin per unit. Then I'm going to have another column for sales mix. And then the final column I need here will be the weighted average contribution margin per unit. So we have given to us there the unit selling price for bats and the unit variable cost. So $90 selling price, $50 is the variable cost. Our contribution margin per unit is $40, right? And then for gloves, oh yeah, this is a really bad example, and I apologize. I actually saw this last semester and I meant to swap out this exercise. Just bear with me. This is just a terrible, terrible example. But we're going to have to deal with it because it's what's in here. So, but I take full responsibility because I chose this exercise. The reason it's a bad example is because both of those products have exactly the same contribution margin per unit. It should not be that way. And I blame the textbook because they picked those numbers. But I also didn't swap out this exercise, so my fault too. The procedure that we're going to use will work for every exercise, but it's totally unnecessary in this exercise because of that same contribution margin. But we're still going to go through all the steps and you'll see how to apply it. And then we'll be able to use this in in a future exercise as well. So the sales mix is 40% bats. And the sales mix always must add to 100%. So even if they had not told us, since we know they sell just these two products, it would have to be that the other 60% is for gloves. We then multiply across. So we take the $40 contribution margin for the bats and multiply by its weight or its percent of sales mix, 40%. So that contributes $16 toward the weighted average contribution margin. And then we do the same thing for the gloves, $40 contribution margin times the 60%. And that contributes, $24 toward our weighted average contribution margin. Here's why this is a terrible example. Because the weighted average contribution margin, not at all surprising, is $40 because we applied weights to $40 and $40. But all I did, I still followed all of the steps. We could easily, you can easily see how we would do this if it was $40 and $30, for example. Your weighted average contribution margin, if you're looking at only two products, the weighted average contribution margin is going to be somewhere between the two individual unit contribution margins. And of course, is going to be closer to the one that has the higher percentage that carries more weight. Now that we have that weighted average contribution margin, we can use exactly the same formula that we have been using to calculate our break-even units. Whoops, gotta put your fingers on the right keys. Break-even units. We take the fixed costs, which are given as $620,000. Whoops. And we divide by that weighted average contribution margin. And so the break-even units $15,500. That's the total number of units that this company, Dragon Sports, needs to sell. We were told that 40% of those units would be bats. So 40% of 15,500 is 6,200. So 40% of the total break-even units would be bats, and the other 60% would be gloves. Or 9,300. This question asks us for break-even units and then units for each one of the products. You could also, if you were in business, if you were trying to manage your company, you might also be interested in, well, what are our total revenues? So how do we go from our units to our revenues? What do we need to do? If we sell 6,200 bats, how much revenue is that going to contribute? How do we find that number? How do we convert units into revenues? How much are we charging for the bats? $90. Yep, so we're charging $90 for the bat, for each bat. So if we were to take the 6,200 units and multiply by $90, that would get us to our revenues from the bats. We would do the same thing for the gloves, multiplying the units times the $105 selling price. So that's a reasonable question to ask as well. How much revenue are we going to produce? Okay, any questions about applying the sales mix, even though, as I said, this is just a terrible example? Okay. We will keep going then. In this exercise, exercise 9, as we frequently do, we're going to be looking not at a manufacturing company, but at a service company. And so we are told Zero Turbulence Airline provides air transportation services between Los Angeles, California, and Kona, Hawaii. A single Los Angeles to Kona round trip flight has the following operating statistics. It tells us to assume that fuel, crew salaries, and airline depreciation are fixed, regardless of the number of seats that are sold. So that's the first 3 amounts that are given there. Just going to do some quick math and find our total fixed costs by adding those 3 pieces together: the fuel, the crew salaries, and the depreciation. It is absolutely believable that the salaries and depreciation would be fixed. I would suggest that the fuel may not be completely fixed, that having more weight on the plane would require more fuel. But this is one of the assumptions that we make. And we know that if that's not true, if our fuel does have a little bit of a variable piece in there, that we need to build in a little bit of a margin of error, margin of safety to take that into account, that there may be some additional fuel cost if we have a very full plane, and that we may need to, that we may save some money on fuel if our plane is a little bit less full. Or as we see planes doing today, if they are limiting the weight or the amount of carry-on baggage you can have and that kind of thing. We're first asked to calculate the break-even number of seats sold on a single round-trip flight for the overall enterprise product, E. Assume that the overall product mix is 10% business class and 90% economy class. So we are given the ticket price and the variable cost per passenger for business and economy, and we can go ahead and calculate the contribution margin for each one. And then once we take into account the sales mix, we can calculate the weighted average contribution margin. In this exercise, we're going to do, weighted average. This exercise, we're actually going to be able to use and see how it works to calculate the weighted average contribution margin when we have different contribution margins for each product. So we'll start with, doesn't matter which one we do first, but we'll start with business class because that's listed first. What's the contribution margin from a business class ticket? Well, the revenue or the sale price is $800 and the variable cost is only $140. So the contribution margin is $660. Since I'm on this row, I'll just keep going across. We're told that the sales mix is just 10% business class tickets. And so $660 times 10% is a $66 weighted average contribution margin from the business tickets. And then we can go to economy. Try completing the economy row on your own. Whoops. There we go. Okay. My lines are exactly matching, but close enough. And so what do we see here? We had contribution margins for some of the tickets of $660, but other tickets of $180. The vast majority, 90% of our sales are those economy tickets with only a contribution margin of $180. And so the weighted average contribution margin is much closer. It's between the two, but it's much closer to the 180 than it is to the 660. And that is what you should see. So now that we have that weighted average contribution margin, we can calculate the total number of seats we would need to sell at break even by using that same formula that we have been using the past number of exercises. So break even units. We take the total fixed cost that we've already calculated and divide by that weighted average contribution margin. And we would need to sell just 60 seats on our plane to break even. Of those 60 seats, 6 would be business class, and the other 54, 90%, the other 54 would be economy class tickets. Before I started using CNow, everything we did in class was in Excel and templates that I created for the exercises. And using Excel would make showing you something much simpler, because I would have formulas in here and I could just tweak one number so you could see what would happen. If you change this sales mix to 5 and 95, the impact on our results would be dramatic. And I'm just going to do a quick calculation here. That would change our weighted average contribution margin to $204 rather than $228. And that would mean rather than selling only 60 tickets, we would have to sell over 67, just over 67. If we sold exactly 67, we would lose just a small amount of money. So we'd really have to sell 68 tickets to cross that break-even threshold. As a percentage, that's a huge difference, right? To go from 60 to 68 tickets just to break even. And so going back to those assumptions that we talked about, the assumption that the sales mix is constant and that we know what it is, that it stays the same throughout the period that we're analyzing is really critical. Because if it turns out we're wrong, then it can have a dramatic impact on the robustness or the validity of our CVP analysis. Okay, so at this point, you know how to use CVP analysis if we're selling a single product to find break-even units, to project profit, how many units we would need to make or sell to hit a certain targeted level of profit. We saw in one of the exercises what we would do or how we could use this if one of our parameters change. So we talked about what would happen if you change the selling price. We could change anything or multiple pieces in that calculation. What if we wanted to change our level of profit? What if our fixed costs went up? What if our variable costs went down? What if we changed the selling price? So we can tinker, we can do kind of what if scenarios using that formula and modifying any one of the assumptions that went into it. Everybody good so far? I need to give me 1 second here to get down. There it is. Didn't have written down what slide I wanted, so moving on then, as we finish up this chapter. So we know how to use CVP analysis. We know the assumptions that go into it. And I've mentioned this term margin of safety a few times. So since we know that some of our assumptions may not be 100% valid or true, they may not hold up, and we know that affects the reliability of our results, we may want to build in a margin of safety. We may want to check to see, well, how close are we to maybe losing money if we're talking about a break-even analysis. And so what we're going to be doing in exercise 10 is calculating the margin of safety. And we're going to calculate that both in dollars and as a percent of sales. The usefulness of knowing the margin of safety is it tells us our risk. It's an assessment of risk. What if we're wrong? What if something that we plugged into that model, the CVP analysis, turns out to be wrong? How critical is that going to be to our results? And so here's our calculation. Margin of safety can be expressed in dollars of sales, units of sales, or percent of sales. So the margin of safety in dollars is the numerator of the formula that's here. Sales minus the sales at the break-even point, excuse me. Sales minus sales at break-even point is our dollars of sales for our margin of safety. Then if we divide that by sales and express it as a percent, that's going to be the percent of current sales. Units of sales would be, of course, the difference between our break-even units and the units at that projected level of profit. So let's go to our final exercise for the chapter, exercise 10. And I have no idea if this is a real company. I generally think that the companies in these exercises are fictitious, are made up for the exercises. But looking at this word, I don't know how to pronounce that because I don't know the origin of that word. It could be Kanachi, that could be Canase, I don't know. Whatever it is, if this company has a break-even point at $960,000 of sales, has actual sales of 1.2 million. What is the margin of safety expressed in dollars? So again, we take the actual sales of 1.2 million, subtract the break-even point sales. We did talk about how that break-even point would be calculated. And so we know how to find the units, and to convert the units into dollars, we would just multiply by the selling price. And then as a percent of sales, we take that margin of safety in dollars and divide by the sales, 1.2 million. So they have a 20% margin of safety, which seems pretty realistic to me. Seems like that's a good, nice cushion. You might be comfortable with that. Our sales could decline by 20% and we would still break even. And most companies are not happy with just breaking even, but it gives us a frame of reference. Our next exercise, or the next part, the last part of this exercise says, if the margin of safety for the company was 20%, and then it tells us their fixed and their variable costs as a percent of sales, what was the amount of their actual sales in dollars? So it suggests we find their break-even sales, break-even in sales dollars first. So since we don't have an exact formula for finding this, I would recommend when you encounter something like this that we go, we fall back on, well, what do we know? We know how to find break-even units. And the break-even units are fixed costs divided by contribution margin per unit. So if you don't intuitively see what do we do with this, we just start with what we do know and see if that will help us get toward what we don't know. So their break-even units is what we're trying to find. We are told that their fixed costs are $1,875,000. And their variable costs were 80% of sales. And so they're, let's see. So we don't know their contribution margin per unit. Let's try a different approach. We can't go any farther with this, but they are asking for break even in sales dollars. So let's see if we can do something with that. Break even units times selling price would be their, and then if we do this whole thing, let's see. Whoops, how did that happen? Selling price. Okay. Whoops. Okay. So if their fixed costs are 1,875,000, variable costs are 20% of sales. So they're, I'm trying to think, I already know how to find the answer. I'm just trying to think how to tell you how to, without giving you a new formula. Okay, so if their break-even point was, or sorry, excuse me, if their variable costs were 80% of sales, and that means that 20%, if they just break even, so if their total fixed, I'm trying not to give you a new formula. Fixed costs, what do we already know? Fixed cost plus, whoops, variable costs is their total cost. So that's common sense, right? Fixed cost plus variable cost equals total cost. And we know down here, we know their fixed costs are 175,000. We want their variable costs were 80% of sales, and we want to just break even, which means our total costs are the same as sales. That's the break even point, right? Total cost being the same as sales. So now without giving you a new formula, I can show you how to find this. So if their total cost equals their sales, they're going to exactly break even. That means that 20% of their sales, just solving for the missing piece here, 20% of their sales, whoops. Okay, so I'm combining the two like terms. I'm moving the 80% sales to the other side. I'm subtracting 80% from each side, whichever of those approaches you like to hear. And so in order to just break even, their sales would be fixed cost divided by 0.2, 9 $375,000. Okay. We took their fixed costs divided by 20% to get sales by itself. These are our break-even sales. We would have to sell 9,375,000 just to break even. The question then is, if their margin of safety is 20%, we don't add 20% on top of this. We want 20% of their total sales. So we want to know sales of 9,375,000 is 80% of what? That's our variable. 80% of total sales. If we have a 20% margin of safety, that means our break-even point is 20% less than our total sales. So we want to know 9,375,000 is 80% of what? If we then divide each side by 80%, oops. We get total sales must be 11,718,750. The most common error with this kind of a question is related to the difference between, put these terms on the screen, markup and margin. So markup means you start at the price or the lower point and add on top of it. Margin means we go from the revenue or the selling price and go down. So margin is the percent of the total sales, where markup is based on the total cost. Markup is going up. Yeah.
How did you get the 9,375?
Yeah. So right here, so let me just walk through this calculation again. So I was trying to put this in terms of things you already knew rather than giving you a brand new formula. So we know that fixed costs plus variable cost would be the total cost.
Right.
And if it's break even, that total cost would be the same as sales. That's the break even point. So I just plugged in what we knew. We knew our fixed costs were 1,875,000. That was given right here in the exercise. We don't know what the variable costs are, but we are told they're 80% of sales. So I just plugged that in, 80% times sales equals, and I plugged in sales for total cost because we knew that that's what it would be at the break-even point. Now I had 80% of sales on one side of the equation and 100% of sales on the other side. So I subtracted 80% from each side to get the fixed cost equals 20% of sales. Then I divided each side by 20% to get sales equals 9,375,000. So I had 20% of sales here. I had to divide by 20% to get the full sales.
Okay.
Does that make sense?
Yeah.
Or you could think of it as multiplying by 5. 20% of sales would be 1/5. So if we wanted to know the full amount of the sales, we just multiply by 5. If that helps think about it with the math. And then I knew that our margin of safety was 20%. So I had to find out that break-even sales is 80% of what number. And then our total sales right here.
So if the total sales, like back in red box,
Mhm.
sales equals the 9 million.
Yeah.
So how does
That's the break even sales. Sorry, just, I should have labeled that.
Okay.
So I should have labeled this as break even. And so if that's the break even sales, what would the full sales or the actual total sales be
Okay.
if there was a margin of safety of 20%? Anybody with questions? Okay, I'm going to clear the drawings, and as I like to, I'm going to put my green check marks in there. And this is the end of chapter 20, so I'm going to stop the recording at this point.